in Australia, I see a lot of sense in the Oil Search Santos tie-up. And so, we've been supporters of Oil Search for a while now. They've got some great strategic assets in PNG. And when you think about who the big customers are going to be for things like gas moving forward, it's going to be the Asian countries, whether it's Japan, South Korea, China, and you've actually seen the demand profile for China to import gas and oil has increased. They expect it to increase from around 42% worth of imports for gas, as an example, to around 50% over the next few years. So, PNG assets are in a really good spot there because they're in great proximity to those Asian customers. Oil Search has some really great strategic assets with long-term gas contracts. And then when you think about the Santos and Oil Search tie-up, you're getting some really great cost synergies coming out as a result of those two businesses coming together, saving around $120 million in CapEx per annum, bringing those two businesses together. But what I'm really excited about is bringing in, that Santos management team to manage these Oil Search assets and really deliver on execution there, because that Santos management team has been absolutely excellent in terms of operational capability in recent years. What they've been lacking are those high quality assets. And so you're bringing those two strong capabilities together, creating a top 20 global player. I think it'll be around the 16th largest energy player globally, listed here on the Australian market. So that would be my play for an Aussie investor.
And some other assets that we've been talking about yesterday, of course, is James Hardie. It's been riding the tide. Monetary policy, fiscal policy, you name it. Everyone wants to build and build now. But is James Hardie currently priced for perfection?
Yeah, it's really in the sweet spot. I think what was interesting yesterday is you are continuing to see James Hardie upgrading their earnings guidance. So they upgraded their earnings guidance by around 4% yesterday. So you're looking at around 580 to 600 mil now for the range for earnings for FY22. Really interestingly, when you think about the US market, which is their key exposure in building materials, capacity is running really, really high. And so all these building materials producers are really struggling to get capacity out there. James Hardie has been benefiting from that because they've been investing heavily in their capacity in recent years. And so they've actually been taking market share. So not only do they have all those tailwinds you were talking to, but they're also taking market share in this environment because their competitors just can't get materials to their clients, and the backlog is getting worse and worse. I've been receiving a few questions from investors around, the slowing new housing market in the US. But what we're seeing is the repair and renovation market remains very, very strong. And you've actually got a 2-year backlog when you talk to these different companies for building materials orders. So I think you play this out over the next 2 years. James Hardie's in a great spot to continue to take market share. They've actually just started to launch some really great premium sideboard products that will improve the pricing mix. So they're upselling to their current customers into higher margin, higher priced materials. And so you're going to get a really good combination of taking market share, but also improving pricing. And obviously in an inflationary environment like what we're seeing at the moment, that will obviously benefit them and their ability to put price rises through at the moment. So, I think for James Hardie, to your point, it is priced very strongly at the moment, but we continue to see earnings upgrades on our numbers versus where the market is based on those market share gains, but also the pricing mix coming through from James Hardie. It really is in a sweet spot.